G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. I'm here with Chris Bays from the Alcove Group, mortgage specialist. G'day, Chris. How's your week been?
Going well, Pete. A little bit nervous. We're leaving the kids for the first time tomorrow. We're going to Queenstown for a few nights. Excited on one hand, but also nervous to leave them. My boy's 4 and my daughter's 5.5 now, so they're at a good age. But we've actually moved this holiday, I think, 4 times because of life, and he probably wasn't ready, my boys. So finally making our 5-year wedding anniversary happen about 21 months later. But what's the news with you?
Nice. How long are you going for? And is that I assume that's Queenstown, New Zealand, not Tasmania?
That's right. It's funny because I put Queenstown, Tasmania into Bomb the other day, and I was like, actually, no, there's 2 Queenstown. What's going on here? Over in New Zealand, we're going to do a massive hike. One of it's called the Root Burn track, I think it is. It's a 4-day hike. We're going whitewater rafting one day getting bikes out and doing all the tracks around Queenstown, and then do a romantic lunch and onsen spas, and then a dart jet, which is like up in the sort of a longer one that goes up all the rivers, I think. So action-packed few days, hopefully come back safe, and hopefully the kids don't miss us too much. I'm sure we'll miss them more than them.
Sounds amazing. I don't want to hear that you've been checking the auction clearance rates on Saturday evening. You should be focused on the away break. It'd be interesting to see how the trip goes. A brilliant place to go and visit, of course. Also, some of the vibes out of New Zealand in the last year or two, I suppose with the economy slowing down, there's been a lot of Kiwis make the journey over to Australia, and it looks like maybe they've reached the bottom of the interest rate cycle over there, at least for the official cash rate. I guess the way the mortgage market works there, people will still be seeing lower mortgage rates generally over the next year. But it'd be interesting to hear what the vibe is like. I guess they've had a challenging year or two since the property cycle peaked and the economy has slowed down. I've been Sunshine Coast this week. Went down to see the Province Summons NRL trophy yesterday, get a little picture, because obviously a good season for the Brisbane teams. I'll be down in Brisbane actually myself this week, seeing a few clients, and also the Ashes is on, so there'll be Poms everywhere, no doubt. Just like everybody else in the industry, trying to get various bits and pieces finished as we sort of move into December. There's not so much, there's still quite a lot of auctions happening. Last weekend, there was over 1,500 in Sydney and about 1,600 in Melbourne. So that huge rush to get stuff sold before Christmas is probably just gone beyond its peak over the past week or so. In terms of the private treaty market, well, there's not so much coming on now, so it gets pretty hard for people wanting to buy property. And I guess, do you often see at this time of year things start to drop away? I assume yes, hence you're going to Queenstown.
Yeah, absolutely. I mean, new inquiry really dries up now. I mean, makes sense, right? Do you really want to start a pre-approval process a few weeks before Christmas? It doesn't really make sense. But a lot of people do come back and just want to check their numbers and start that process, and then start to reconsider it in January. So, this time absolutely slows down. But, I mean, it makes sense. New listings have really dried up. I mean, some of the stories we're going to cover today, I mean, Catality's numbers feel pretty strong in November for a growth. I mean, a 1% rate, percentage rise in November is still a 12% annual rate. So, I do feel like there's a lot of heat in the market. I was up in Newcastle on the weekend, and, my best mate's trying to buy up there at the moment. And, he's quite seasoned on property. I've been working with him for a good decade. He's switched on, and the market up there is moving really strongly, and particularly under sort of that 1.5 mark, and this 5% deposit scheme. I think Newcastle is really benefiting from that. It's going to be interesting to see what happens over the next few weeks around just sort of people's rate expectations. I mean, you can see the media's really latching on to this sort of bounce in inflation, and people like Warren Hogan's come out today and saying for a rate increase, not decrease. And I think there's a real sort of noise getting created that coming into sort of January, that no, rates aren't going to even drop in 2026. There might even be an increase. And I'm just curious to see how that changes, buyer sentiment. We're one of the first lines of sort of the leading indicators, I would say, when we can see existing clients come back, new client inquiry, people sending strategies back really fast. we can really see whether there's strong buyer demand. And it's going to be interesting to see what happens in the new year.
It definitely is. I think a couple of points there you raised. So the totality figures, obviously there's a lot of momentum. Perth prices were up 2.4% over the month. So the momentum in that, those sort of second tier capitals. I don't like the phrase second tier, but anyway, people would know what probably mid-sized capitals is probably a better phrase. Perth prices were up 7.4% over the quarter. Brisbane and Darwin also very strong. I think, as you said, though, it's not the same everywhere. Melbourne, 0.3% increase, so fairly flat. Also, Ray White said their index was pretty flat for the month of November. But exactly what you said, I'd been to a few open homes on the Sunshine Coast, and when you get that sort of nicely presented first home buyer property, it's suddenly like moths to a flame. There's people all over it. A friend of mine who's a buyer's agent, Rob Power, was saying that in Ipswich they've seen the same thing. The sort of entry-level properties where the first home buyer scheme is kicking in, suddenly there's been some big jumps in prices, but it's not necessarily the same all the way across the whole market. So obviously that 5% deposit scheme, we've seen all the modelling, but it does seem to be having an impact on those sort of entry-level properties. I guess the other big news story this week, as you said, well, the interest rate, if you look at the yield curve, well, no cuts or even hikes priced in for 2026, and very, very flat now, looking all the way through 2026 and maybe through 2027 as well, and maybe a hike getting priced in for 2027. But the other thing is that APRA has finally started making some noises on the macro-prudential measures. At this stage, it seems like a bit of a very sort of gentle tap on the brakes, but effectively limiting high debt to income borrowing effective 1 February 2026 to 20% of loans. I saw with some amusement in ABC News that one of the commentators said it was like banning 8-foot-high people from restaurants, because at the moment we're only seeing about 5% of loans that are at the sort of high debt to income ratios. So limiting it to 20% doesn't really have an impact, except maybe in some specific cases. But I guess that could be a forewarning of what may be to come if investor lending keeps growing.
So funny, Pete. You and I sometimes were reading the same lines. I read that line in that article and actually had a proper chuckle. And I love when economists and, they try to come up with a real life sort of relatable sort of story. I mean, 8 foot's pretty, probably a bit too high. I don't think there's many 8-foot people in the world, but maybe a 6'6" or 6'8" tall person. But you're right, it's going to affect very few borrowers, the APRA change. But I do think it's a little bit just like a soft warning sort of shot, a rubber bullet saying, hey, if this gets out of control, we're going to have to start making some tightening. But I do think it's a little bit pointless. I mean, the amount of DTI lending over 6 times is quite small, but it's also saying, hey, we're watching this. We are going to make changes. We're not afraid to sort of slow it down. And I do think they will really target the investor market, and potentially, if obviously with rates staying higher, their sort of appetite to sort of reduce the assessment buffer is sort of smaller. I think they're going to really want to see rates get under control. So, APRA stepping in 2026 to cut the buffer, probably unlikely at this point. And I mean, I did a blog post about 4 to 6 weeks ago, probably saying APRA's going to step in to not saying I'm Nostradamus or anything, but, just to cut sort of investor lending. And we could really see that was a problem. But no, I think the bigger change to investor lending was the attack on trust lending, which we've seen over the last few months or so. Macquarie jumped out, and, CBA jumped out. A lot of, I guess, watching behind the scenes would be happening with the bank lending for, trust lending and self-managed super funds. I think that could be a one to watch in 2026. I think another crackdown or another, pressure on banks to look at that again would be my bet.
Yeah, I suppose these measures apply to ADIs, deposit-taking institutions. So there's always that kind of release valve of the non-bank lenders. I think as well, I mean, I guess if you went back to when interest rates were at zero, There was a bit of lending at 6 times income and above, but then as interest rates have gone up, it's kind of stopped it anyway. I think, I assume the regulator will be looking at all the same data series that the rest of us do, and there's a bit more of a clue in the RBA's financial aggregates in October. Investor credit growth was 0.88%, which is the strongest in a decade. And that comes off the back of the ABS figures for Q3, which showed investor lending was up like 18%. So I guess that's the concern, is that if that becomes a runaway train, then APRA wants to be able to step in and maybe limit, put some caps on investor or interest-only lending, but probably still just watching it mostly from the sidelines at this point. Quite a few other news stories this week. Lots of talk about housing affordability, of course, with the cost of a typical Aussie home, according to Domain, 8 times household incomes, worst on record. I just saw one news story this week. It was in Bloomberg, but also ABC News and elsewhere, that Trump is talking about pausing immigration from third world countries. Now, of course, the president in the US often says a lot of things and doesn't necessarily follow them through. But I thought it was an interesting story, just in the context of we've already seen the NZ exodus as people go looking for employment opportunities. Emigration from the United Kingdom hit an all-time high this year in 2025. Canada's population growth is more or less slowed to zero. And it seems like the places, the opportunities and places for people to go, that net has been closing in quite a bit in 2025. I think there was a period post-COVID where there were lots of places to go in the world, and now not so much. So potentially an opportunity for Australia if we can attract some of the best and brightest. But I think with Trump, often what he says and what ends up happening are not necessarily the same thing, but certainly the vibe is in that direction.
Yeah, I mean, we are in a compete for global talent pool as well. And I think just this anti-immigration stance that even just saying third world countries just is not nice, to be honest. And I think, if talent around the world want to come and add value to an Australian economy and work here and live a better life in their mind, then absolutely, I feel like we should have open doors. Obviously, we've gone maybe a little bit too high on immigration in the last few years, but even pre-COVID, we sort of had, I guess Gladys was coming out and saying, hey, we've got to slow down immigration. We need our infrastructure to catch up. And then COVID happened. And then it was like, no, we need more people here to work because, we haven't got any, there's lots of jobs that we need people in. And so, I don't know, it will be a story though in 2026, Pete. I think it's when house prices and rental crisis is out of control and there's a real lack of options for people, then that people naturally then go, the first shot that people attack is immigration's too high. And I think that while that's might be a little bit high at some point, and there might be gaps that are getting flaunted in the system, often, you can't really, scale it back too much. Our economy is basically built on it. So, but I mean, that's another story I think we'll have to cover a lot in 2026, together with the building, what's going to happen with development. And I think that'll be an interesting one to track next year.
Yeah, sounds good. One other interesting story before we do our big 3 news stories of the week. Noted economist Ray Wise saying the AUKUS deal could be significant for Western Australia, with more than 20 billion of investment to flow into the shipbuilding precinct and also for some of those big ship and submarine projects. So it's not quite the same as the mining boom, but it's I suppose it's just more investment into an already red-hot economy and particularly housing market, which is already very stretched. It's a good point. I guess a lot of momentum. And if you look at some of the housing market forecasts for 2026, a lot of them seem to expect just more of the same in some of those markets that have already been booming. So let's go through our big 3 property news stories of the week. Stick around because at the end we've got time for some of your listener questions in our Q&A segment. So first story, residential construction growth fastest in a decade. I think there was a nice lift in residential construction in the ABS figures. I think you can sort of see now in southeast Queensland, I haven't sort of travelled around quite so much in recent weeks, but there's cranes starting to appear on the skyline, Brisbane South Bank, a lot of projects getting up and running. Gold Coast in particular, lots of big apartment projects approved and now starting to break ground. So I guess you could sort of say on the flip side that maybe there's only a sort of a window of opportunity for those big developments to get delivered before people start turning their attention to the infrastructure projects for the 2032 Olympics. But I guess if you look at some of the figures, Westpac said residential construction picked up 4.2% over the quarter. The expansion was 9% higher in annual terms, which was the steepest outside of the pandemic since March 2015. And house construction has picked up after a lull, but it was notable that apartment construction has picked up in New South Wales, picked up in Melbourne, it's picked up in southeast Queensland. So I guess, look, it's early days, of course, but this is how the last boom started a decade ago. People were saying we're stuck in an undersupply, the system's broken, and then suddenly as prices rose and interest rates got a bit more favourable, suddenly there was construction happening all over the place. And maybe this is a part of that interest rate story, is that, yes, there's a hole to be plugged in the economy, but maybe a residential construction boom over the next couple of years is what plugs the gap. And that's what that's what kind of picks up the baton, if you like. So, because are you seeing any sort of more construction in New South Wales as you travel around?
I'm slightly obsessed with this at the moment, this story, Pete. I'm tracking every single new development that's coming with it's quite easy to do this stuff. Once you start digging, you find the right websites to look at. And basically you can look at major projects with the New South Wales government, and they've got like anything over 60, 100 million. And basically they lodge it with the government to get sort of faster approval. And so you can track these things much easier. And it's crazy. I mean, even I don't know, in Manly, last week there was a development approved. It's way higher than anything else on the street. In Rose Bay as well, a huge development got approved. And this is a massive change. It's just a huge shift to what Sydney was always built on. It was built on, kind of low rise, low density in the affluent areas, high density in certain pockets, say, for example, around the airport or Chatswood or Epping or Rhodes or Wentworth Point or, Parramatta, and then Greenfield Estates. This is not the way. And New South Wales government launched the pattern book designs. They did it for townhouses and, sort of smaller sort of split blocks, a few months ago. But this was for pattern book designs for apartments, and some cracking architects and some cracking submissions, to be honest. And I mean, I've been saying it for a long time. I think the next round of building boom, the quality of the apartments will be way better than what we built for the previous 20 years. Not just in terms of the design and the materials and sustainability, but the livability of the buildings, the quality, the lifestyle benefits of communities and additional services, whether it's health or et cetera. And even just like things like passive design and, et cetera. So Nightingale, I've sort of know them quite well. And what they've been building for the last basically 10 years has always been sort of on the cutting edge of sustainability and a new way of building. And that sort of is kind of what's happening now, is the next wave. And I think in Sydney, it makes so much sense. I mean, developers could probably only make money in certain postcodes just due to the cost of building up is actually really expensive right now. But when you look at Perth, which was our previous story, you can see the apartment market's gone up a lot over there. So maybe the Perth market could have a bit of an apartment building boom. Even the Brisbane apartment market's been going up quite a lot over recent years. I mean, that was flatlining for a long, long time. Melbourne's really a laggard. So I think that, where they're probably only going to be able to build there is that sort of affluent downsizer product similar to Sydney, and people getting out of houses and wanting to lock up and leave in a boutique apartment in Toorak or something like that. I think we're at the start of a decade-long building boom. And, if anything's going to help us, create more affordable housing, it's building more supply. And I think our cities are going to have to shift and evolve, which is going to probably upset some people because depending on what they own and where they live, some suburbs are going to change away from what they used to always be. And change is hard.
Already happening. I saw Brad Caldwell Isles selling a massive development site down in was it Rose Bay this week, 170 million as owners clubbed together. I think you're right. I think if you look at the stats, Brisbane or southeast Queensland, it looks like construction volumes are sort of picking up sharply. They measure this stuff as in chain volume measures and values. And there may be some distortion because the price of construction is up a lot over recent years. I do wonder, there's no shortage of infrastructure works. I saw in New South Wales over 10 billion of work done in the quarter. So that's kind of back to record highs. Victoria's had its big build and the metro project completing. So I suppose there could be some cost implications here as well. If we've got so much construction going on all around the country, I think it's already an issue, as you said, in Western Australia. What about the sort of apartment oversupply commentary? Because this is how the previous cycle started. Everyone said we'll never have enough dwellings, there's nowhere left to build. And then suddenly there was a lot of places to build, and we got a big sort of overhang of apartments in some pockets. How long do you reckon before people start talking about oversupply risks again?
It's just funny you say that, Pete, because in the last week, I've just started thinking, hey, how's this going to play out, right? And, is there enough buyers to buy this premium product, because these apartments are very pricey. And when you've got one option, then, and like this big group of houses selling for 173 million, okay, great. That well done to the owners, to be honest. I mean, selling, I think it was 11 houses for, let's call it 15 million a pop or something like that. Way more than what they'd be worth just by themselves or pre any zoning change. And so who wins there? Well, it's probably the owners of those houses. And who's the losers? Well, houses around that probably aren't going to get developed because they're going to have a lot more development in the area. And I don't know, like it's some of these zoning changes, the amount that's going to flood the market, is there going to be enough buyers for it who that have got the borrowing capacity and want that product? And, hopefully there is, because, what you'll find is a lot of those will shift out of houses. So that'll create houses that maybe have got way too many spare bedrooms that maybe the next generation can, upgrade within and actually use more of those properties. And that'll then free up a smaller house or an apartment that maybe a younger family can upgrade into. So we sort of start to use our housing stock for the actual demand, like actually, allocate the amount of dwellings we have to the right amount of people. And unfortunately, you've probably got too many people sitting in houses that they don't need, but they didn't have a viable alternative. And so maybe we just have to sort of have a bottom up or top down sort of housing supply sort of pyramid we need to add more on. But yeah, I agree, Pete. Like, are we going to start to find that, they can build this, there's zoning, the developers have these projects, but they just can't get the pre-sales and then they just don't get built. That is starting to happen.
Well, let's see how that plays out. It's always interesting just seeing how the cities evolve, if nothing else. So let's have a look at the second story of the week. Monthly inflation gauge hits 3.8%. So we've now shifted towards the monthly inflation figures in line with lots of other countries. I do wonder if we get a bit ADHD with this stuff sometimes. I think it's good to get a monthly read on inflation, but also it does mean that people are jumping at shadows a lot more. Share traders and currency traders and interest rates and all the rest of it. I think, sometimes there was something quite nice about the slower cadence of the quarterly measure, even if it was a bit sort of lagged. Anyway, the new inflation gauge showed headline inflation at 3.8% over the year to October. Just for context, the target band is 2 to 3%, and 3.3% for trimmed mean or core inflation, which was above market expectations of 3.2%. So, as you said earlier on, Chris, market's sort of toying with the idea now that the next move is a hike. I think there's a couple of things. One is when you get a new index, there's always going to be a bit of caution around how to treat it. I think as well, there's some big sort of known supply shocks in there. Electricity prices were up slightly ridiculous, 37% from a year ago. So I think the federal government will be under some pressure now to renew rebates. And I think... there was, I suppose there was sort of the administered or indexed prices were really where the inflation was coming from, not so much from the market, if you like, or market set prices. So I think some of those factors maybe won't be repeated. Westpac said there are some known items, known supply shocks, where we see little to sustain the current inflation pulse into 2026. So they're still sticking with interest rate cuts next year times 2. I suppose the other side, though, is that housing costs seem to be up. Rents are up. Property rates are up. New dwelling prices. I guess those are the competing forces. We'll have to wait and see as the new index gets bedded in. But certainly, when you've got a headline inflation rate of 3.8%, so we've suddenly jumped back up. I think we're above almost every other developed country in the world now. Maybe the core inflation is more realistically where we're sitting at just above the target band. But I guess the RBA is going to be very cautious around those numbers over the next 6 to 12 months.
Pete, I'm going to put you back on the spot here. So with the inflation data, what were we doing before? Also quarterly, and you got your monthly now. Like, how has it sort of shifted since, the olden days on how we used to measure sort of inflation?
Well, I guess the thing was that the monthly inflation releases have been around for a little while. So we've had them through 2025, but there was always a general sort of cautionary note that we shouldn't necessarily treat them as gospel because they didn't cover every item in the index. But now we've moved towards the full monthly inflation gauge. So what we used to get was a quarterly reading for headline inflation, then we had the sort of sort of more analytical measures they were called, which was basically trimmed mean inflation, and then the weighted median inflation reading, which seems to have gone out of vogue a little bit. Now everyone focuses on trimmed mean. So the idea with those is to strip out the volatility around some of the items that are up and down quarter to quarter. So I guess other parts of the world, if you look at, for example, the US, we get a full inflation reading every month, and it was felt that maybe that would give us a better real-time reading of what's going on. So that's the direction of travel. Still, though, it's sort of early days, so we don't know exactly how some of these new sort of indexes will play out. But at the first reading, anyway, it's very high inflation at 3.8% over the year. So, I guess, did that answer your question? I'm not sure.
Oh, no, I think it does. I think we just need to be aware of these are monthly, and sometimes we can get jumping at shadows. Not to say we shouldn't look at it, though. I think that's I think people are, like you say, getting very reactive to these numbers because I think everyone's very concerned around the cost of living, and they don't want rents to reaccelerate, or they don't want, electricity or food or, cost of build or housing. So that, I guess we just don't want the inflation to keep getting out of control and rates to stay higher. Everyone definitely wants to get to the other side. And but the reality is if it's there in the system and it's staying around, then we've got to potentially try to get that genie back in the bottle. And I think that's just maybe the harsh reality. We're not going to talk about it on another episode. Just actually we're going to record it after this around 2026. And, Louis Christopher in his boom and bust report basically did 4 scenarios, and none of those scenarios spoke about higher rates. And that shows that this sort of has just sort of caught people by surprise over the last couple of months, that inflation's maybe going to be a bit higher. There's always the people that are often the doomsdayers, the property bears, that are saying, oh, no, this is what you should always have expected, inflation was always going to be stickier, and, the know-it-alls, I guess you would call it. But it has caught people by surprise, I guess, and that's why the RBA cut pretty strongly this year, 3 times with expectations of more, because they probably thought that inflation genie was back in the bottle, but even they've been caught out a little bit.
Oh, yeah. If you're ever on social media, you get no shortage of that. But I'll just point out as a counterpoint to that people were saying when the cash rate target went from the zero lower bound to 4.35%, that this was going to lead to Armageddon in the housing market. Last quarter, Perth prices were up 7.4%. So interest rates are clearly a big factor in housing market cycles, but they're not everything in the market either. Just final point on this story. Shane Oliver from ANP said prices administered and indexed rose 7.8% versus 2.8% for market-related prices. So, some government intervention here. So, I mean, basically that means things like property rates, utilities, childcare and healthcare, things like transport fees, education. So, I mean, I guess you could certainly say that monetary policy actually has far less impact on that part of the market anyway. I think there's always 2 sides to this stuff as well. I mean, if let's say you're a property investor with a bit of mortgage debt, you're probably not that unhappy to see 3.8% inflation just inflating away your debt. And I suppose investors have also benefited from a 40% increase in rents over the past 5 years, which is a big part of the inflation story. And I suppose, when interest rates go up, then it slows down dwelling construction and vice versa. So there's always a sort of a yin and a yang to this stuff, but it does look increasingly like there may not be any further monetary easing in this cycle. Let's wrap up with one more story before we do the Q&A from Eleanor Creagh at REA Group. Will Australia become a nation of renters? So she goes through the stats to show that renting is clearly on the rise, which I think is what you'd expect. I did an interview with Michael Yardner yesterday, and he was showing how the population of Australia has gone basically from 21 to 28 million over the last 2 decades. So 7 million extra people, new arrivals into the country, about a third of the existing population arrived since 20 years ago. So I guess in that context, you would expect there to be more renters. But as Eleanor shows, we've still got a lot of first home buyers around. So we're not going to become a nation of renters anytime this century, even though the share of renters is projected to rise steadily from the 2030s through the 2050s. But it looks like the modelling shows we wouldn't get to more than 50% renters until, well, no time this century anyway. Maybe in the 2100s or something is possible. But, you don't really know what will happen over that kind of timeline. I guess that kind of makes sense, though. We've got an aging population, big population growth numbers. So I suppose you would expect the sort of home ownership rates to be generally lower over time.
Yeah, I don't know, Pete. I think this is one where I think that there's probably still a few, tricks in the back pocket that the government's going to use to, encourage people to still buy. You've got this help to buy sort of government sort of equity schemes. We've seen accessing super, maybe the, multi-generation families coming together and, granny flats will be, the next thing, or cutting up blocks. I do feel like there's this sort of, and the more that has become, because you've got to really, the other way is to actually increase investment, and it's really hard to, create more dwellings to sort of rent, really, and I mean, there's articles out right now about cutting CGT for investors. I mean, that's anti-investor. I mean, if you want to create more rental accommodation, then you want to encourage investment. And so, I don't know. I think maybe the tide's going to go down. We're just trying to encourage more people to enter the market to buy something. And I do think it's going to get harder and harder to sort of rent. And the harder and harder it is to rent, the more you want to buy, right? Like if, you look at rental costs, for example, in a lot of capital cities over the sort of 2010s, when it was very pro-investor, rents didn't go up because we just kept building, right? And a lot of investors were building buying high density, and that meant that you weren't forced to buy. I'll just be a rent investor. But now all of a sudden that cat's out the bag and rents have accelerated, and that desire to own, if anything, has just increased. So yeah, I do. But I do think that unfortunately the property market is really becoming a haves and have-nots and inequality. And so more and more people are forced to rent because they just can't afford to enter, whether it's the borrowing capacity or the cost to purchase or servicing mortgages. And so, yeah, that is becoming bigger and bigger issue because you can see in all the data, it's not the median incomes that are buying. It's more the sort of upper sort of 30-40% of incomes that are actually transacting. And so then that's basically marginalizing a huge part of society that can't afford to buy.
Well, that's the I suppose the downside to APRA's buffers and actually with macro-prudential measures as well. I think there's no free lunches in economics, and if you introduce restrictions on who can borrow, there is always a cost to that. I saw Isaac Gross pointed out in his Substack this week that sometimes you might have a family where one part of the couple stops working to do raising some children, but they can't refinance to buy a bigger home because they've temporarily got a lower income and things like that, where you sort of introduce 3 percentage points lending assessment buffers or debt to income caps. So all those people are then precluded from borrowing and trading up to a bigger home. So there is always a cost to this stuff. And the lending assessment buffers, it basically makes it harder for people who have incomes under 100,000. I think, I think, as you said on the inequality point, Australia doesn't score too badly if you look at the Gini coefficient on income inequality. But I think wealth inequality is rapidly widening. We don't have big inheritance taxes in Australia or death duties like a lot of European countries, for example. So that the gap between the haves and the have-nots definitely has been increasing and probably will continue to increase. I think just to wrap up on Eleanor's points here, she said many of the same life milestones that used to exist still do exist. It's taking people longer to save deposits and they're buying homes later than they used to. I think she said by 2050, over a third of Australians will be age 55 or older, which paradoxically does actually increase the home ownership rate, because generally speaking, home ownerships do rise with age. So it's kind of a bit sort of cause and effect there. But I think one trend that is definitely interesting, and it will probably continue, is that the share of people who own their home outright has been declining. I think more people are taking mortgage debt. They're either paying it down more slowly or they're taking it into retirement. I think a lot of people are thinking, well, if I live to 65, I might have 20, 25 more years, maybe longer. So they're not rushing to pay off the mortgages like they used to, maybe in days of higher interest rates.
Oh, this is a bit of a big story, Pete, that one of the things we don't want to see to basically support the housing market and keep pushing prices up is an expansion of reverse mortgages, allowing people basically to stay in their homes and, not be forced to downsize. So they can basically just release the equity and live off the equity and then just sell their home, tax-free to the kids. We're absolutely seeing that. Even the government allows people to do this now, very good terms. And so, I think absolutely. Not only are people going to get to retirement with much more debt, I think we'll see an expansion of interest-only terms or expansion of longer loans. And it will just be more and more common that people get to retirement, and whether they pay it down or not, whether they just hold debt into retirement, really depends on, whether that's better to take money out of super or sell other investments, or maybe they just keep holding on, or they do a reverse mortgage or whatever it might be. But I think that's absolutely, bank innovation's going to, continue to be in this space. We've seen a lot of new products over the last 5 years in this space. And I think that's just only going to continue, which basically isn't good, because what you're allowing people to do is this huge amount of equity. And basically you're allowing people just to say, oh, well, I won't downsize, which basically then just doesn't reallocate our housing supply to the right people who need it more. And that will only create tighter supply, which means obviously pushing prices up, not down.
Yeah, those reverse mortgages, I think they had tougher capital requirements in the past, and they haven't been that popular in Australia, but people are finding ways and means now. So definitely a trend to watch. Let's see if we can rip through a few listener questions before we wrap up for the week. So here we go. Question 1 from worrier. I have more than a 5% deposit. However, I don't want to live in an investment property. I really want to buy a house to live in. Given the housing shortage, should I wait for more supply to come online or give up on the great Australian dream? Chris, you must come across that scenario as a mortgage broker from time to time. What do you say to people?
I very much want a house. I'm so assuming they can't afford to buy a house.
Probably not the house that they want. Yeah. So it may be a question of buy an apartment and get on the ladder, or do I just save for longer and hope that I can afford a house later on?
Yeah, so more supply is probably not going to lower prices. So unless something's going to change in your situation, i.e. more wealth's going to come down or your income's going to go up, waiting for more borrowing capacity, so same income but more borrowing capacity with the banks, probably not a good idea. That'll probably get quickly factored into prices, so you just end up paying more. I think that's fair enough if you don't want to own an investment property. I get that, and you want sort of home security and stability, and maybe you don't get a house, maybe get a garden apartment, or get an apartment with a really green outlook that's in a bit of a leafy part. So you sort of get I guess it's trying to figure out why did you want a house as well. Maybe for a little pet, maybe get a really pet-friendly building, or you want something, or you have kids, and but get into a family, apartment block. Some apartment blocks definitely don't appeal to families. Maybe it's like the balconies or the noise or whatever it might be. But I don't know. I do think as the cities evolve, more and more people are moving to sort of higher density sort of living, and so you can still find sort of needles in the haystack there, and places that feel like a house, but it's just not a house. And so I wonder if that's an option. Or do you sort of look at maybe going a bit further afield than where you are living today, and maybe going, okay, I'm going to increase my commute time. Maybe my lifestyle benefits aren't going to be as good to what I like today, but I've got ahead of the curve and I've got something I can live in, and maybe I'm just going to have to spend a bit more time traveling around to see my friends and family and getting to work, but I've got something that I want to live in long term. And so you don't have to buy an investment, I think, but you kind of also got to be careful waiting for the world to just do you a favor, because that also could mean that you just shoot yourself in the foot as well.
I mean, trading up later on. Okay, thanks, Chris. Second question from IP, not so freely. Nice Simpsons reference there. I've recently taken equity out of my now old place of residence, a townhouse, to buy a house together with my fiance. We're both approaching 30. The townhouse is now an investment property and the new house is our place of residence. With the original debt of the townhouse and equity taken to fund the new house's deposit, the rental income will cover both of the loan repayments. So it's pretty good. The IP is what I believe to be a desirable area in the city I live in. Probably not an A-grade investment, if I'm honest. All the talk of getting an A-grade investment property from podcasts has been questioning whether I should sell it and upgrade this investment to something of better grade, or whether it's just a throwaway line. The cost to buy and sell just to swap an investment property just doesn't seem to make all that much sense to me, with the cash flow how it is on the investment property at the moment, especially when that extra money can be used for shares or for paying off the non-deductible debt faster. So yeah, I get this sort of question a lot. Yes, I mean, I suppose when you run the numbers, if you think about the capital gains tax to sell a property, plus you're going to have to pay maybe a few percent in real estate agent fees and legal fees. Then when you come to buy the next place, you're going to have to probably pay 5% or so in stamp duty, plus all those transaction costs again for the conveyancing. It's quite a lot. And I suppose, it depends how long you own the property for and some other variables. But basically, you're going to have to be pretty confident that the new place has capital growth of at least 2% per annum more than what you're getting currently to make it worth your while. It obviously, you can run the numbers yourself, but you'll see it depends on how long you plan to own the property for and so on. But it needs to be a better investment to justify the effort, if nothing else, especially if you're currently in a position to extinguish your non-tax deductible debt. So look, I'm an accountant and I don't like paying CGT where I don't have to. So I've got a kind of a bias towards not selling unless there's a big issue with the property, in which case that changes the dynamic. But what do you reckon, Chris? Should you bite the bullet, suck up the costs and get something better?
So I don't think they're going to pay CGT here, Pete, because it's saying here, I've taken out equity out of my old PPOR.
Okay,
so if it's old PPOR, you probably sell that one tax-free.
Yeah, fair enough. So
I'm thinking,
call it 10% costs, yeah.
Yeah, exactly. So if you're not paying CGT, that then means that maybe it's better to sell. That's the first thing. I agree, though, because if you are paying CGT, that's a huge cost that, then you have to sort of, but I mean, often this situation when someone tries to keep their first home and then buy a new home, it makes sense to sell, let alone for a better investment opportunity, just because you can restructure your debt. And if you've got a lot of equity in your townhouse, basically means that even though you've used that equity to buy a home, that's non-deductible, because even though it's secured by an investment property, you used it to buy a home. And so by selling the townhouse, you could then reduce your home debt quite dramatically, I imagine. That'll put a lot less pressure on your cash flow. And when interest rates are 5+%, that's quite a big margin you can, save on just a cash flow point of view by having lower home debt. And then we could then reuse the equity on the home to buy an investment property. Depends on whether you need to do a reno as well on the new place. You might want to not use all your capacity. Depends if you need to reno it now or whether you can wait a bit. But often this situation, if you just look at the cash flow benefit of basically restructuring your debt and reallocating it to having lower home debt and higher investment debt, you'll find that you'll have a cash flow benefit every year. And then your cost to transact really probably is only stamp duty and selling costs on the investment property. And you might find within 3 to 5 years, you might have recouped those costs, and let alone then maybe restructured into an better investment property to hold for the next 20, 30 years. And so, yeah. And I mean, I do think if you've got an asset that you are holding as an investment property, if the fundamentals aren't right, that's what you just need to question, whether it's the demand or the supply. The issue you find with townhouses, often you can build more townhouses, and also the demand usually isn't as strong than say it is in the housing market. But all townhouses aren't equal. You've got the high density cookie cutter ones that you can just easily replicate and they age really fast if they were built in the last 20 years. And then you've got a group of townhouses and villa units, and they were much lower density. They're in more affluent areas. They're in good streets. And those type of townhouses grow like houses, I would say, because they're just really scarce and they're bigger and they're really leafy and established gardens, and they're really desirable to families. So it depends on what type of townhouse you got as well. And it really depends on whether you've got the borrowing capacity to not only do this transaction, but actually get a good investment. You might find that it's better to hold that townhouse for another 6 to 12 months, do it in 12 months' time. There's a lot of momentum in the market. You're better off just sort of, trying to ride that wave for another year or two. Or you might income might be shooting up in July. You might run your own business or something. So, yeah, I can't give you all the answers with this, but there's some of the things you need to think about.
Yes, be opportunistic. I think, yes, you're right. There's a few variables. Just reading the wording of the question there, I've recently taken equity to buy a house. So maybe CGT actually isn't a factor you need to account for there. So good thoughts, Chris. Nice thinking. Let's finish with one more question, and we'll wrap up for the week. From Chimichurri Investor. Hello, Rask team. We've just bought our first home. I'm working part-time because we've had a baby. So for a couple of years, not much extra money will go for savings. I have to choose between adding extra to my mortgage, extra to my super, or investing. What is better to prioritize? So, yeah, I think, we're going to do an episode on property versus shares for the Christmas series. So that'll be one to keep an eye out for as to whether there's much value around in stocks and shares at the moment. Super is always tax effective, but of course, at this time in your life, you may have better use for the funds outside of the super, especially if you just had a baby, you've only been able to work part-time lately. So, Chris, what would you focus on first there? Building up a bit of a buffer or paying down the mortgage?
Also one of those ones where you just don't know. It's not enough facts, right? So the things you want to think about is, have you got much savings left over, as a buffer? How much equity have you got in your property? Could you release equity as a buffer as well? Or are you really running things tight? If you're running things tight and you haven't got much buffer, then just trying to build up a sleep at night sort of emergency fund makes sense. Making sure you haven't got any other debts as well that are to pay off before you look to do other investing. You've got it, but don't do other investing really if you're not going to use debt to do it, would be my also thing to think about. So obviously you want to sort of try to get ahead of your mortgage, pay your mortgage off first, and then use equity to whether you're buying shares or property. That's just a 101 there. But if you're not doing that, super is always super attractive. Like, yes, you're tying money up, but you get a tax break for doing so. And I don't think your 60, 65-year-old self's going to say, hey, why didn't you put that extra $2,000 in your super fund? Like, that's now worth whatever it is in 30, 40 years' time. And so, I do think you sort of try to use that as much as you can over the years. You'll never sort of regret it, I would say. So hopefully that answers your question as well.
Cool. Thanks, Chris. Well, send in your questions for next week. We're always keen to answer your listener questions in our Q&A segment. I'm down in Brisbane this week, so by the time this goes to air, it's probably 2-0 to Australia in the cricket, but let's not even go there. Chris, when are you heading off to NZ?
Tomorrow morning. So I forgot about the Ashes. Like you say, it's probably only going to be a 2-day test again, but might try to get a little bit of that over in New Zealand as well. I think the wife will be happy with that. But off on Wednesday morning, and look forward to chatting next week.
I think I might have to shut down my social media for a week if England lose again. So thanks for all the insights this week, Chris, and enjoy New Zealand, and look forward to chatting next time around.
See you next week.
Cheers. Thanks, everyone.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.